Let's take a look at the different options for financing multifamily properties in today's market. So first on the left column here, and first of all, thank you to James Eng of Old Capital. Bank loans on the left. So this is your typical bank, local bank, regional bank, credit union. On average, the loan term will be 3 to 5 years, no minimum loan amount, interest only. Will be a little more restrictive. Banks will usually allow up to 12 months. So the first 12 months of only interest only payments just depends on business plan and the relationship. Amortization could vary from 20 to 25 years, and that's negotiable. So if they start at 20, you might be able to bump it up to 25. I've never seen 30 years on a bank loan product. Not saying it doesn't exist. I've just never seen it. Max loan to value is 75%. The nice thing about bank loans, in most cases, they'll have a willingness to include rehab costs into the loan as well. So rehab budget and loan included. So that's something you could consider if the numbers make sense, where you could roll in all or a portion of your rehab into that loan, up to 75% of basically the after repair value, which is the loan to cost if the rehab is rolled in. If there's no rehab component, it'll be loan to value. Basically, what is the appraised value? They'll loan 3/4 of that up to. Debt coverage ratio 1x. Usually I see more, maybe 1.2, 1.25, like you would on agency debt. And then occupancy minimum flexible, it just varies. You can buy a building that needs a lot of work, might have higher than average vacancy, and the bank would be okay with that because they're basing on your pro forma figures. What is your projected rent, and what is your projected net income? So if you can get the bank to their debt coverage, once all is said and done, the dust settles on the work, then you'll be in good shape. Prepayment, it varies. So James mentions typical prepayment for a bank loan will be step down, meaning you might start at a higher percentage of the loan amount if you sell it sooner. And it steps down. It could be 5, 4, 3, 2, 1, 5% of the loan amount if you sell it year 1, all the way down to 1% of the loan amount if you sell it year 5. What I see as well locally is could be no prepayment penalty if you refinance with that same bank, or maybe up to 1% if you do not, if you just sell or refinance with another lender. Supplemental loans, can you over time draw out additional funds or a second loan, for example, after your initial business plan has been executed, potentially with the bank? And what level of experience does a borrower need to qualify for a bank loan? Would anyone, a new investor, the caveat would be you just need to have qualifications for your net worth and your liquidity, your amount of the cash that you have in the bank after you purchase the building. And that varies by lender, but they might have some requirements around that. You could pull in other co-guarantors for that loan to qualify. Current range of interest rates, 8 to 9%. It's what James mentions. That's pretty accurate. I might see some in the mid 7s. Freddie Mac small balance loan, SBL. This is an agency loan product specific to multifamily. They're looking for a loan amount of $1 million or higher. This is non-recourse. I forgot to mention that with bank loan is typically full recourse. There's some exceptions. They might have partial recourse, so they could draw down or slowly evolve over time. But typically, a bank loan is full recourse. In other words, if things go south and now the bank's looking for to get their money back to pay off the remaining principal balance, they can come after you or any of your partners. With a Freddie Mac small balance loan, there's limits to that. So you're a guarantor on the loan. You might pull in other individuals to be a key principal for you, which is basically another term for co-guarantor, signing on the debt. And they cannot pursue your personal assets unless there's certain triggers that you need, where there's called bad boy carve-outs, where you do things incorrectly or you lie on your financials or you don't run the building like you say you are, whatever. You have to make sure you're clear on what those exceptions are, but otherwise you're not going to be able to pursue your personal assets in the event of default. So minimum loan, 1 million. Loan term varies 5, 7, or 10 years based on the loan term that you select. Typically, when you get a term sheet for agency debt, they'll give you these 3 options. And the 5 years will often be tied to 1 year of interest only. 7 years will be tied to 2 years of interest only. And 10 years will be tied to 3 years of interest only.
So that's your different loan terms and the interest only options that come with that. Amortization will always be 30 years for an agency loan. Loan to value up to 80%. In reality, it's going to be lower, just with interest rates being higher. You're not really meeting the debt service coverage requirements as readily. So I typically see more like 55 to 65% loan to value as opposed to 75, 80 like it was a couple years ago when rates were lower. Minimum occupancy has to be stabilized at 90% for agency debt. Rehab budget not permissible to include that into a Freddie Mac small balance loan. Prepayment penalty would be stepped down in most cases. So that could be 5-5-4-4-3-2-1 for a 7-year, or a 5-4-3-2-1 for a 5-year, meaning a percentage of the loan amount when you go to sell, if you sell prior to the end of the term. Supplemental loans are not permitted on Freddie Mac small balance products. In other words, we can't get a second loan. If you do really well, the net operating income goes up significantly higher, rates drop down, things like that. You wouldn't be able to pull additional cash out without doing a full-blown refinance. New investors are accepted into the SBL program. You might need a key principal or someone that does have experience. And again, you have to meet certain net worth and liquidity requirements as well. So if you can't do that on your own, you can pull in other partners to meet that requirement with the bank. Current range of rates, 6s until low 7s. Freddie Mac Conventional, this is a larger loan product, so $7.5 million and higher. Similar as far as interest only, is going to vary based on the term that you select. You'll be given options, and the rates that correspond with those options will vary as well. Amortization 30 years, max LTV 80, but in practice it's going to be less in most cases, just given the state of the market with interest rates and prices still slowly coming down. Debt coverage has to be 1.25, and that's 90% minimum occupancy. Same thing with the Fannie Mae, which we'll get to next. Rehab budget can be included in the loan with the Freddie Mac Conventional, which is nice if there's a value add strategy. And the prepayment is typically 1%. Supplemental loans are also permitted down the road too. You can get a second loan to pull out more cash. This is for experienced investors. Current range of rates, high 5s into the mid 6s. It's could be floating 2 to 2.5% over SOFR. Fannie Mae, this is for $1 million or greater loan amount. Interest only period 1 to 3 years. You can get up to 12 years term. So again, the longer your term, typically the longer the IO period that you can elect. Amortization 30, LTV the same, debt coverage the same, occupancy the same. Rehab budget can be built in, and this is a yield maintenance. So the risk with yield maintenance is if you're starting with a higher interest rate day one and rates decrease, meaning that if your loan is paid off and now they want to redeploy that capital, they're going to get less interest on that loan. So they're going to look for you to, there's going to be a significant yield maintenance penalty. If your rate starts lower and rates go up and you sell the building early, you might actually have, it'll be much less yield maintenance, but it's very unpredictable and could be incredibly expensive if you're caught on the wrong end of that equation if you try to sell early. Supplemental loans are permitted, and you have to have experience as well. Rates are similar to the Freddie Mac. And then bridge debt. Bridge debt could be floating rate, it could be fixed rate, and that's something that you do if there's a value add strategy or it's below the required stability as far as occupancy goes. You can get in there, you can execute your business plan, get the income up, get the occupancy up above 90, and then later on convert that bridge debt into permanent agency debt. So the bridge to agency is a viable product. It's just taking typically some risk with the interest rate. And with traditional non-recourse bridge debt, there might be a requirement for what's called a rate cap, which is kind of insurance on how high rates could get. That might be very expensive today. Depends on the size of the loan, but for I've heard of some cases where they're several $100,000 for the larger deals. So with non-recourse bridge, it's going to typically be interest only for the first, it could be 2-3 years, could be up to 5 years for certain bridge products. They're looking up to 80% loan to value. And there's going to be some flexibility with the terms more so than the traditional agency debt. This is for experienced investors as well. But again, you can gain experience in the eyes of the lender with partners. So you can pull in other partners that have the experience and together as a team, take down a property and qualify for whatever debt you're pursuing. Current range of rates could be 8, 10, 12% with the goal to convert that into agency debt, or another debt product could be a bank loan after you get the building stabilized and the income up to where it needs to be to qualify for that next loan. Hopefully that's helpful. This is a little bit outdated, so I'll be looking for James's update here in March, and I'll post those. This is a helpful snapshot for me when I'm underwriting opportunities to see what makes the most sense. And typically what I'm looking for, I love the agency for the non-recourse. The 30-year amortization helps with cash flow. Some cases the bank loan makes more sense. If I'm buying a building, for instance, there's one I looked at that's 20 units, but 7 of the units were vacant. In that case, it would not qualify today for agency debt. So I either have to do the bridge product to start, convert it to refinance to agency down the line, or go with a bank loan, which is fine too, but then it's full recourse in most cases. So pros and cons to each of these just depends on the situation, what you're dealing with.